So, how much income do you need to qualify for a mortgage in 2024? The short answer, it depends. And that's probably most situations. Any question you ask in our space, the answer usually is it depends. There's never a one size fits all. So, what I did was I put together two different scenarios on how much you should make, budget, and what the mortgage might look like. So, you know, going into home buying, what the numbers might look like. Every lender is going to look at three things: credit, income, and assets. And I'm going to help you kind of start with budgeting and what the income might be for you to qualify. My name is Stef. I'm a licensed loan officer, and I'm going to go through really quick two different scenarios. So the first one is John Wick, right? Let's say John's like, okay, I'm ready to buy a house. He makes $80,000 a year. His monthly income is $6,667. So if you look at his debts, what lenders do is they're going to say, okay, you make a certain amount of money every month, but what do your monthly debts look like, right? And generally, your monthly debts cannot exceed 50% of your gross monthly income, meaning your pre-tax income. So here we have a car balance of 12 grand, a credit card balance of 4 grand, and student loan balance of 20 grand. So John Wick is obviously, like he went to school, he got a car, he has some credit cards. This is like the average scenario of like the standard American. But what lenders look at is the minimum payments on every loan. So they don't really look at how much you're paying yourself. They look at what is the minimum requirement. So in this case, he's got a $250 payment, a $120 payment, and a $200 payment. Altogether, outside of the future mortgage, his payments are $570. So the lender is going to say, okay, we're going to take that $570 and now we're going to add that with your mortgage, and then we'll take that with your income, and that's going to tell us if you're qualified or not. Let's say he's buying a house for $300,000. He's a first-time home buyer, which means you could put 3% down. Now your loan amount is going to be $291,000, right? 300 minus 9. Average interest rate, I would say right now is around 7%. And so let's just be safe and put it at that. Principal and interest is $1,938 with a PMI of $80 a month. Taxes is $200 a month, and insurance is $90 a month. Honestly, the taxes and the insurance, I was pretty conservative. I think generally it might be higher than that, but it's okay. For now, his mortgage payment is $2,308 a month. Okay, so now the lender says, okay, you want to buy this house for $300K, okay? We're going to take your mortgage of $2,300 and we're going to put that against your income with the debts that you have. So we have his total monthly income, his debts of $570 here, plus his mortgage payment. Your total monthly debt payment is $2,878 a month, meaning at bare minimum, every month, this borrower, this person has to pay this much, okay? Now, the DTI ratio, we take that number divided by your income. We get 43%. Does this qualify? Yes, it does. John Wick, congratulations, you qualify. The DTI ratio is below 49%. Sometimes you're capped at 45%, but right now, recently, I've been seeing people, you can go up to like 49 for conventional loans. So in this example, he is all set to go. Now, DTI caps are important. They're to protect you. They want to make sure you're not over leveraging yourself. Let's look at Britney Spears, for example. Let's say she's ready to buy a house, right? She wants to settle down, and she makes an annual income of $90,000 a year. She probably makes a little bit more than that, but we'll be conservative. Her monthly income is $7,500 a month, okay? Let's look at her car balances, her credit card balance, and their student loan balance. Not car loan balances, just one. But anyway, we have a minimum payment of $375. 180, and then 150, right? For these three debts. Total, $705 a month, okay? Let's say she wants to buy a house here in 456 Oak Street, Sample Town, US for $450,000. Down payment is 3%, which is $13,500. Loan amount's $436. Interest rate, we'll do 7%. Honestly, I have a feeling Britney Spears' credit is probably not that good, so I'd probably give her a higher rate, but it's okay. We'll do 7. Here's her principal and interest payment with her PMI, her taxes, and her insurance, okay? Total payment is $3465. Total monthly income is $7,500. So let's take her debts, add it by her mortgage. Now we have the total monthly debt payments of $4,170. Her DTI ratio is that number divided by her income. We're at a cap of 55%. So does this qualify under conventional standards? No, it does not. When I say conventional, it's just a type of loan program. You can also go FHA, and she could probably buy down the rate in this example, go with an FHA loan, because FHA is a little bit more lenient when it comes to debt to income ratios. But if she's trying to just do the loan like this, she wouldn't qualify. What if though there's an example? What if you don't? What if you don't qualify? Like, what options do you have, right? Well, what you could do is find a home with a lower purchase price. Okay. The second thing you can do is put more money down to reduce the mortgage payment. And then you could pay points. So what this means is lenders offer you as an option, you can pay a couple extra grand at closing to buy down the interest rate permanently. So instead of getting a 7%, I can put up maybe 5 grand and buy it down to a 6.75. The trick with that though is you want to make sure your break-even point is within 2 to 3 years. In this market right now, paying a lot of points doesn't make sense because you can just refinance, and we're expecting refinances in a couple of years. And then, so if you refinance too soon, your points will not break even. Meaning, if I'm saving $50 a month, but I paid $5,000, you want to figure out how long does it take for my $5,000 to be recouped by my $50, right? With my new payment. So, paid points, reduce rate. There are temporary buy downs and permanent buy downs, but those are the 3 options, honestly. You could find a lower insurance quote. This is another option as well. So maybe we can reduce monthly insurance just for the loan to get it to work. But really you're not going to see a lot of changes there. I would say those are the 4 pivots. You could also find a cosigner on the mortgage, assuming they have decent credit and income, right? So if this person has a lot of debts and they don't have a lot of income, they're just going to pull your purchasing power down. You want to find someone that has hopefully okay enough credit. When I say okay, I mean above 660, and they have at least enough income left over after all of their debts. So those are I would say the 5 ways to basically, if you don't qualify, to make it work. And so I hope that helped. Those are the 2 scenarios. If you have any more questions, feel free to reach out to me. And we do a lot of first-time home buyer transactions, and so I can kind of break this down more in detail based on your specific information. Thanks.